We all hear the stories, right? Fortunes are made when companies go public. But what about the fortunes made long before any IPO bell rings? Today, we're going to pull back the curtain on the high stakes, kind of hidden world of pre IPO investing. This is a private marketplace where early startup employees, who are millionaires on paper but can't pay their rent, meet savvy investors who are hunting for a piece of the next big thing, years before you or I ever see it on the stock market. The potential returns here are just staggering. We're not talking about doubling your money or even getting a 10x return. No, we're talking about 1,000, even 10,000-fold gains. An early investor in a company like Uber, they saw returns at the absolute peak of that unbelievable range. And that's exactly why we call these billion-dollar startups unicorns. They're supposed to be mythical, right? And they create this truly life-changing wealth for the very, very few who manage to get in on the ground floor. So how does this hidden world actually work? Let's break it down. First, we're going to start with the really unique and frustrating problem that these early startup employees run into. Then we'll dive into the special market that was built to solve it. We'll get into why there are such steep discounts and terrifying risks. And finally, we'll follow the path from a private share all the way to a potential jackpot on the public market. All right, first up, let's meet the main character in this whole story. And it's not some venture capitalist or a Wall Street banker. Nope, it's an early employee at a booming tech company. And they have a very strange, very modern kind of problem. Okay, imagine this for a second. You joined a promising startup way back in the day. You believed in the mission, so you poured in the years, the long nights. You sacrificed a big salary for a big chunk of company stock. Now, let's fast forward. The company's a huge success, and your stock is worth millions. You're finally ready. You're going to buy that house, pay off your student loans, just take that dream vacation. But there's a problem. All that wealth, it's just a number on a screen. It's trapped. You literally can't touch it. So how does this wealth even get created in the first place? Well, to get top talent without burning through all their cash on huge salaries, startups issue new stock directly to employees. And this is a genius move, really, because it gives everyone skin in the game. They're owners now, not just workers. But creating new shares also dilutes the ownership for everyone else. Think of it like a pizza. If the company issues more stock, it's not making the pizza bigger. It's just cutting it into more slices. Your slice is now a smaller percentage of the whole pie. And this setup is what creates what's called a liquidity trap for that employee. And get a load of this number, $2.5 million. That is truly life-changing money. Our employee opens up their benefits portal, and this is what they see. They are a millionaire, but only on paper. What a frustrating paradox, right? They have the wealth to solve all their problems, but until they can turn that stock into actual cash, it's just an idea. This is the key question, isn't it? It seems so obvious. If you own $1 million of Apple stock, you just log into your brokerage account and you can sell it in seconds. So what makes our paper millionaires situation so different? Why are they stuck in these golden handcuffs? Well, the answer all comes down to the huge fundamental difference between public companies, the ones we see on the news every day, and private companies, which it turns out operate in a completely different universe with its own set of very weird rules. You see, the public market is this giant, well-oiled machine. It's like a brightly lit supermarket. There's always a stream of buyers and sellers. Prices are totally transparent, they're right there for everyone to see. And this massive infrastructure of brokers and exchanges handles everything. The private market? Yeah, it's the complete opposite. It's more like some dusty old bazaar. It's illiquid and opaque. There is no line of buyers waiting for your shares. Every single deal is a unique, complicated one-off negotiation. Think about how ridiculously easy it is to sell a public stock. You log in, you click a couple buttons, and your broker's algorithm instantly finds a buyer somewhere on the planet. The whole thing is done in seconds. The crucial point here is that for our paper millionaire, none of this global automated machine exists. There is no magic sell button to click. So, if the public market is a dead end, where does our employee go? Well, this is where things get really interesting. A specialized, much more secretive market comes into play. It's called the secondary market, and it was created to solve this exact problem of pre-IPO illiquidity. Okay, so a secondary transaction is fundamentally different from when a company raises money or has an IPO. In those cases, the company is creating and selling new shares to raise cash for itself. Think of the company like a bakery selling fresh loaves of bread. A secondary transaction, that's just a transfer of existing shares. It's you who already bought a loaf, selling it to your neighbor. The bakery isn't involved. No new bread is created. The money goes from the investor straight to the employee. So here's a little story of how this usually plays out over years. In year one, the company grants stock to our early employee. That's the primary issuance. By year four, the company's grown, the valuation is way up, but our employee needs cash for a down payment on a house. They find an investor and they sell their shares in a secondary sale. Finally, let's say in year seven, the company has its big IPO. This is the exit that investor has been waiting for so patiently. It's their very first chance to sell those shares on the open public market. Okay, this all sounds pretty great for the employee, right? But it brings up a huge question. If these shares are from the next big unicorn, why on earth would our employee agree to sell them at a massive discount? I'm talking 50%, sometimes even more, of their on-paper value. Well, an investor buying these shares is basically walking into a minefield of risk. First off, the company could just go bankrupt. Poof, the shares are worthless. The big planned IPO could be a total disaster, like what happened with WeWork, leaving the investor stranded with no way to sell. The private financial data they're basing their entire decision on could be incomplete or even misleading. And maybe most importantly, their money could be locked up, completely illiquid, for 5, 7, maybe even 10 years. So that 50% discount, you gotta understand, that's not some crazy bargain. It's the price of admission for taking on all that risk. You know, Warren Buffett said it best. Price is what you pay. Value is what you get. From the employee's point of view, they're not really losing 50% of their wealth. No, they're paying a price to get something incredibly valuable, immediate cash, and a complete offloading of all that terrifying risk. And for the investor, they're paying a price for the potential to maybe, just maybe, capture the full undiscounted value down the road. In theory, both sides walk away happy. So let's follow that investor. They've paid the discounted price, they've taken on all that immense risk, and they've waited patiently, maybe for years. How do they finally cash in and get those 1,000 times returns? Well, they need an exit. They need a path to the public market. These days, there are basically three main ways to go public. You've got the classic IPO, like Airbnb did, which is kind of like a grand debutante ball where investment banks introduce the company to the world. Then there's the direct listing, which Spotify famously did. That's a more casual entrance where existing shares just start trading. No fuss, no new money. And then you have SPACs. These are blank check companies that are already public, and they merge with the private company, like a corporate shotgun wedding to take it public through the back door. For our investor, any of these is a doorway to finally getting their money out. The ultimate reward, the thing they've been hoping for through all that risk and patience, often comes in this crazy phenomenon known as the IPO pop. This is the explosive moment when a private valuation, which has been just a theoretical number for years, finally meets the overwhelming force of public market demand. Let's use a real-world example. Airbnb. Before the company went public, it sold shares to its bankers and big institutional investors. After all their number crunching, the price they landed on was $68 per share. That was the official IPO price. But then, the very next day, when Airbnb actually started trading on the public exchange, get this, the first price wasn't $68. It wasn't even $100. It was $146. The stock more than doubled in an instant. That is the IPO pop. That massive, immediate gap is the exact profit that early-stage secondary investors are hunting for. They got in at a huge discount years ago, and now they're cashing in on that frenzy from the public on day one. So let's pull all this together. The secondary market is this fascinating hidden world built on a fundamental, high-stakes trade-off. It's about liquidity for employees, immense risk for investors, and the potential for absolutely massive rewards. I mean, when you look at it side by side, the contrast it's just severe. On one side, the risks are total. You could lose every single penny. Your money could be trapped for a decade. You could be misled by faulty numbers, and the IPO might just never happen. But on the other side, the rewards are equally extreme. The chance for a 10,000 times return. Getting a piece of a legendary company like Uber before anyone else. This isn't just investing, it's a high-stakes bet on the future. And that leaves us with the ultimate question. For investors, when you're staring at the possibility of total failure on one hand and world-changing success on the other, how do you even begin to price that risk? For every Uber, there are thousands of failures we never even hear about. So in this high-stakes hunt for the next unicorn, is any discount really deep enough to justify the gamble? That's something for the market and for you to decide.